Good morning, everyone. I'm joined by Ola Adeosun, who's a senior wealth planner within the team. This session is around wealth planning post-lockdown. Before we start the session, I thought it'd be good just to do a quick plug for a note that we issued about 5 weeks ago during lockdown, which basically just went through a few relatively sensible pieces of housekeeping that we would suggest to do if you have slightly more time on your hands. I don't intend to go through this in a huge amount of detail because we're more than happy to resend the note out. The one thing I'd probably add that wasn't covered in the note would be the last point about residency. So if you were one of those people that happened to spend the lockdown period in a country that wasn't your country of tax residence, then I'd probably suggest we have another chat because there's a variety of different things that we'd suggest that you consider over and above that. But this session, we want to focus on where we are now, what we may see going forward, primarily from a tax perspective, looking forward towards the end of the year and also next year, specifically with reference to the autumn statement that we anticipate seeing in November. Some of you may have been on the session that Jonathan Marriott, our CIO, ran around about 4 or 5 weeks ago, and he talked about statistics, often looking harsh and heartless, especially when you consider it in the environment that we're in now. I do agree with him, but I think it's also important to run through some numbers with you to give you some context around the discussions that we're going to be having. So I think you may have seen that the Treasury is now using a budget deficit base case scenario for modelling of 337 billion. If you compare that to the March budget, where the figure was 55 billion, you can see the significant difference that has developed. It's double the 150 billion that was in place immediately after the financial crisis. The Office for Budget Responsibility a few weeks ago forecast 35% drop in GDP for the second quarter. Tax receipts are down 43%. So why are we talking about this? Clearly, I think we're all prepared for some more short-term stimulus. If you hark back to probably a month ago, and I think it was in the invite that we sent through originally for this discussion, there was a lot of talk about having an emergency budget at the start of next week. I think we are going to be seeing some more stimulus coming through. There's been talk about changes to VAT, for instance, but in the medium term, there's clearly a need for the Chancellor to start balancing the books in some way, shape or form. In his words, trying to stabilise the debt to GDP ratio. Now, he's got various different tools at his disposal to do that. But it's almost inevitable, I would say, over the medium term that some of those tools would involve tax rises and also spending cuts. If we just maybe go back to the base where we're starting from for a few minutes, we're coming out of 2 relatively benign budgets from a private client tax perspective, I would say. Certainly, regardless of COVID-19, if we look back to the March 20 budget, there was quite a large anticipation for some fairly significant changes that we'd see in that budget, the one immediately post-Brexit. You don't really hear Brexit mentioned as often as you previously did, and also obviously the first one after the elections, with the notable exception of maybe entrepreneurs relief, where we saw quite material changes, and also pensions, which I think Ola will come on to. The Chancellor did really kick the can down the road in relation to addressing any significant tax issues. But there's only so far that can be kicked down the road, I would say. So what could we see? And again, before I go into a whistle-stop tour of some of the potential changes we could see, I think maybe if we just look at the political side of this for 2 seconds, the government are acting from a position of strength at the moment, I would say. That 4 years to the next election, I think the mindset of most people is they are expecting some changes to come on the horizon. So if there are going to be reasonably politically controversial announcements, then I wouldn't be surprised if those announcements are made sooner rather than later, potentially with maybe deferred taxes coming into place. So make the announcement, get people acclimatized to that announcement, and then the pain starts a year or 2 years down the line. And there's none more so controversial than potentially the 3 top points on the list I put there. So income tax, national insurance contributions, and the pensions triple lock. And the reason why they're largely controversial, and this isn't new, if people have been looking at the press for the last month, a month and a half, I'm sure they would have seen some articles in relation to that. Well, any significant amendments to them would directly contravene the manifesto pledge that the Conservatives made prior to the last election. So there was I'm sure people may well have seen, there was a leaked Treasury document that came out at the start of May, I think it was, which basically outlined a shopping list of potential changes to a whole host of different taxes, but these three were caught within that list. And it certainly made the press, and there's been a lot of correspondence in relation to that afterwards. So income tax, clearly, I think income tax is one of the taxes that generates the most revenue for the Treasury. So I wouldn't be surprised if something did happen. There's a way to sidestep the actual manifesto pledge in not actually reducing the headline rate in any way, shape or form, but instead looking to reduce the threshold that applies to the headline rate. So if we look at it now, you pay 45% income tax on earnings above 150,000 as things stand now. It wouldn't be inconceivable, for instance, for that 150,000 to go down to 100,000. Or at the moment, individuals lose their personal allowance if they earn over 100,000. Again, without changing the headline rate, if that threshold was to reduce to say 70,000 or 80,000, then the government would get tax revenues without directly contravening the manifesto pledge. It's a bit of a workaround, but you could see that type of piece of legislation coming in. Potentially an easier target would be to amend national insurance contributions. It's probably slightly less of a political football, I would say, in the grand scheme of things. If you look at the rhetoric around national insurance contributions, certainly in the past month or 2 months, there's been quite a lot of talk about reducing the disparity or removing the disparity between self-employed individuals and employed individuals. So currently self-employed individuals pay class 4 national insurance at 9%. A lot of the talk and the rhetoric has been to get rid of that and equalize it with employees who currently pay 12%. Some of you may have heard or remember back in the day, Philip Hammond was talking about the white van man tax. I think it's relatively, I think almost invariably that will come in. The question would be, certainly the Institute for Fiscal Studies has been quite vocal in trying to equalize that and get rid of what they believe is unfairness between for employers rather than the self-employed, and there may be further changes to cover that off, given employers also pay additional national insurance contribution. So there could be potentially significant changes in the offing there. One other point on income tax, just before I get around to doing it, just before I go on further, if they are going to change anything with income tax, I think the question probably a lot of people would ask is, will it be targeting the wealthy in isolation? And I think what's relatively clear is, I don't think that would produce enough revenue in isolation to make a material difference. So when HMRC went through, when this Treasury document got leaked reasonably recently, there's some quite helpful calculations that came off the back of that also, which outlined the potential increase in take depending upon tax rises for basic rate and for additional rate tax increases. So a 1% increase in basic rate tax, so going from 20 to 21%, would get the revenue an additional 4.7 billion in revenue. Higher rate tax, so 40 to 41%, was 1 billion. And then additional rates, so from 45 to 46%, was 105 million. So just finishing off that point there, if there is going to be a material change to income tax, then I don't necessarily just think targeting the wealthy in isolation will make a material difference to the overall figures. Finishing off the national insurance contributions point, we could see a removal of the upper earnings limit for employees. So currently anything above circa 50,000 is currently taxed at 2% rather than 12%. There has been talk about a removal or a change to that. If that were to happen, that would certainly increase increase revenues fairly dramatically. but it will also have a significant impact on take-home pay for employees as well. I think the figures that I saw were if you earned 100,000, then that would reduce your net take-home pay by 5,000. Whether or not that's palatable in the current environment, it might be a step too far. Pensions triple lock. I don't want to go through a huge amount of detail on the pensions triple lock. Clearly, it's a very emotive subject, but it's also a very expensive commitment by the government. So we could see probably they'd want to keep it in place as far as possible, but I could see some sort of temporary suspension to it in some way, shape, or form, just to try and reduce pressures in the short term. Corporation tax. So the big point with corporation tax already happened at the end of last year, where the government announced that the removal of the intention for corporation tax rates to go down from 17% to 19%. So corporation tax rates are at 19% at the moment. We would anticipate them staying at 19%. Clearly, it's a controversial subject as well. The UK has probably some of the lowest corporation tax rates within Europe. What we could see potentially more than a change to the main rate is more targeted anti-avoidance. So there has been some talk about maybe the government looking at close investment companies, so privately owned companies where the investment companies controlled by 5 or fewer individuals. Family investment companies would fall into that category, where there's a specific rate or specific rate targeted for those types of companies that is different from the main corporation tax rate. That's potentially doable, but again, I think that's probably more on the periphery than something that we really expect to come through. Inheritance tax. Now, this is something where we do expect to potentially see, if we are going to see things, some fairly material changes, and Ola's going to spend quite a lot of time going through that to run through the proposals on the horizon in a lot more depth. And then we have capital gains tax. So currently there is a disparity between the top rate of capital gains tax for investment income at 20% rather than income tax at 45%. I think there's a reasonable chance that will change in some way, shape, or form. What could they do? They could put it back up to 28%, which is the rate for property at the current moment in time, or they could equalise it out with highest marginal rate income tax, which has been proposed previously, and clearly will probably get more revenue than the 28% alternative. There's been a few other sort of suggestions in the offing. One was to remove the annual exemption or taper the annual exemption, which again I think would probably is an easy target. And then another one that I heard relatively recently was the removal of the ability to transfer between spouses at no gain and no loss. Again, a lot of the planning that certainly we would do with clients at the moment is around annual exemptions and the ability to transfer between spouses. So if one of those changes were to come in, then it would make a material difference. I couldn't envisage a situation where we get to the end of the year where there hasn't been one of those changes to capital gains tax. I think it's invariable that some changes will be made to the capital gains tax regime, just determining what that may be. And then wealth tax. Wealth tax is probably one of the more interesting ones. We've had a lot of conversations with clients, certainly over the last 2 years, about wealth tax. And I'm sure that'll continue. It's being mooted by various different think tanks. Whether or not that would be a flat one-off payment, or whether or not it's a more regular thing, that was a question up for debate. To be quite frank, we already have a wealth tax in the UK that most people probably aren't aware of. The government implemented the annual tax for undeveloped dwellings, ATED legislation, a few years back, which basically taxes high value residential probable that particular piece of legislation gets widened to cover a greater area. They've got the legislation in place. It would be reasonably easy for the government to expand upon it. But I think you also need to look at the context behind this. So go back to 1995, we had 16 OECD countries that had a form of wealth tax. If we fast forward to nowadays, only 5 still have that remaining. So Sweden abandoned wealth tax a while back. The German federal courts came and said it was unconstitutional to have a wealth tax. And France is probably the primary one that historically had a wealth tax, and more recently have gone through a fairly significant realignment of their legislation, where now it's only on property itself. So it can't be ruled out. It's an interesting theoretical one to talk about, but in our minds, it's probably less likely to come in relative to some of the other points that we talked about. And with that, I will hand over to Ola.
Thanks, Simon. So I'm going to cover in more detail potential changes we may see to inheritance tax and also to pensions. Well, before sort of delving into the nitty-gritty details of inheritance tax, I just thought it might be really helpful just to run through some of the more common exemptions and reliefs, which some of you may be familiar with already and potentially already do use as a means of mitigating inheritance tax or making gifts to the next generation. So we have the spousal exemption. So there is no inheritance tax between husband and wife, civil partners, either in lifetime or on debt transfers. Also, there is the inheritance tax nil rate band. So for the first 325,000 of an individual's estate, you don't pay any inheritance tax, and then you pay inheritance tax on the value of your estate in excess of that at a rate of 40%. That has been in place unchanged at that level since 2009. And a surviving spouse can also inherit their deceased partner's nil rate band, which would basically mean that the first 650,000 of an estate is not liable to inheritance tax. There are also a number of smaller exemptions, the most common one of which is the 3,000 annual gift allowance every tax year, which means the first 3,000 gift of to an individual in a tax year, or a number of individuals, but still capped 3,000 in terms of what you can give, is exempt immediately from inheritance tax. There's a small gift exemption of £250 to any number of individuals, and there's also marriage allowances that apply at different rates depending on who specifically is making the gift. A very common one which we discuss with clients quite a lot is the gift out of normal expenditure out of income exemption. So if you're making gift out of disposable income and you're able to establish a pattern of gifting and it doesn't adversely impact on your standard of living, then the gifts are also immediately exempt from inheritance tax, and there is no cap on that. The main residence nil rate ban is another one which is relatively new. That was introduced in July 2015. It's incredibly complex in practice, but effectively as recent as April 2020, the rate went up to 175,000 per individual. And this works effectively if you leave a main residence to a lineal descendant. And if it's available in conjunction with your inheritance tax nil rate band of 325,000, you have a situation where between husband and wife, the first million of your estate potentially is not liable to inheritance tax. However, that main residence nil rate band starts to get removed at a rate of £1 for every £2 that your estate is above 2 million. Once again, outlining the complexity of actually how it applies in practice. Also, there is business relief and agricultural property relief. So if you have a trading business and you meet the threshold of 50% or more in trading activities, then on transfer of that asset, you can qualify for business relief. And the same sort of principle, albeit separate legislation, also applies for agricultural property relief. Gifts to charities and political parties are also exempt from inheritance tax, and individuals can also utilize the heritage asset legislation as well to benefit from exemptions. So those are the main exemptions, just as a starting point before delving further into what potential changes that we might see. So in the next slide, it's probably best to sort of start with, prior to COVID-19 and the events we've seen over the last few months, inheritance tax is an area that the government was already looking at to potentially make changes. As far back as January 2018, the Chancellor at the time commissioned the Office for Tax Simplification to conduct a review to inheritance tax. And the OTS in their consultation issued out a report in November 2018 and also another one in July 2019, and they garnered more responses to their consultation than any OTS reviews that had been conducted previously in the past, outlining the emotive nature of inheritance tax. But the main outcome of the OTS reports was one of reforming the current inheritance tax regime rather than replacing it. They in total made 11 recommendations to the government. Following our talk today, we'll be sending out and sharing the slides with all attendees, and we've actually included the full list of recommendations in the appendix, so you'll be able to look at that in due course in your own time. But effectively, the 11 recommendations centered around reforms to 3 key areas. They looked at lifetime gifts, and at this moment in time, as once again, some of you may be familiar with, when you make a gift which doesn't qualify for one of the exemptions I mentioned earlier, if it's a gift to an individual, then it's potentially exempt transfer, or if it's into a flexible trust arrangement, it's something referred to as a chargeable lifetime transfer. In both instances, the gift would notionally remain in your estate for a period of 7 years before it falls off for inheritance tax purposes. The OTS in their proposal were recommended to the government that the 7-year period was too long, and that should be reduced to a period of 5 years. They were also proposing that any inheritance tax that normally at the moment applies during that 7-year period, individuals can benefit from something called tapering, which basically reduces the rate of tax that will be payable as the year goes by. They were proposing to the government for that to be removed. They felt the gift out of income exemption was too generous, and that the government should consider taking that away. On the capital gains tax side of things, the OTS proposal was that if you have an asset which qualifies for business relief or agricultural property relief on death, then the double whammy that currently applies of getting a rebasing of that asset for capital gains tax purposes on death, as well as then getting inheritance tax exemption, was effectively too generous. So the capital gains tax uplift on assets which qualify for business relief should probably be removed by the government. Specifically on business relief, their main proposal to the government was to change that threshold where 50% is the requirement for you to, of trading activities for you to get the business relief, to be changed to something that we often refer to as the 80-20 rule. Entrepreneurs in the audience will be familiar with the fact that when it comes to claiming entrepreneurs relief, the rules are more stringent relative to business relief, in the sense that you need to, the trading activities of your business to get entrepreneurs relief needs to be broadly 80% of the overall activity of that business. So the OTS were proposing that the government should effectively raise that threshold for business relief as well, to the same as ER. So subsequent to the OTS report, there was also then the establishment of the all-party parliamentary group in February 2019, with the objective to promote understanding of the issues around inheritance and intergenerational fairness. They started their own consultation by initially actually looking at how much tax does the government actually get from inheritance tax, and they established that the government received around 5.4 billion in inheritance tax revenue. In comparison, income tax provides 190 billion, national insurance 137 billion, capital gains tax 9.2 billion, albeit the government suffers the loss in terms of tax intake there by the availability of principal private residence relief when you sell your main residence. They also established that out of 590 deaths in the UK in any one year, only 275,000 of that require IHT forms to be submitted to HMRC, and only 24,500 deaths actually result in a tax liability. So less than 5% of deaths actually result in an actual inheritance tax liability being paid. So based on that, moving on to the next slide, the APBG, having consulted having carried out their consultation, issued out initially an interim report, which I'll come back onto, but then also issued out a final report of January of this year. And I've put this quote in there because it's quite interesting. It was in the first page of their report, which stated that inheritance tax is a tax on transfers of wealth, mainly levied on a person's death, it is often criticised as complex, ineffective, riddled with anomalies, distortionary, and unfair. I think that commentary there pretty much outlines probably the emotive nature of the subject, and once again, why potentially the OTS consultation at the outset received such a huge response. But all in all, the APPG proposal to the government was one of three options. They mentioned option one was the government could consider retaining the status quo. So keep the current regime as it's been in place effectively for the last 35 years, continue to receive 5 billion a year in tax intake. But given the response to the OTS consultation, the view was that the status quo was untenable. They also mentioned the government could take the route of piecemeal reform, take in some of the proposals suggested by the OTS report earlier. And they mentioned that potentially government could just look at replacing the current regime entirely, and that was their preferred option. So retain a form of tax on transfers of wealth, but completely abolish inheritance tax as it currently stands, was their recommendation to the government in the January 2020 report. Moving on to the next slide. The recommendations they made to government are quite detailed, but I've picked out just a few key ones I think probably worth looking at in greater detail. So one of the key recommendations was to remove the ability, going back to what I mentioned earlier, that individuals have an inheritance tax nil rate band of 325,000, and where they make gifts, the gift notion remains in their estate for 7 years before falling off. So a particularly common route of planning is to gift to beneficiaries up to that inheritance tax threshold of 325 or into a trust, live for 7 years, and then after 7 years, make the gift all over again if you have the means to do it. So there's almost a 7-year timeline to that sort of planning. Their recommendation to the government was to completely eradicate the ability to make use of your inheritance tax nil rate band in lifetime. In replacement for that, all individuals will have an annual exempt allowance of 30,000. So obviously a significant uplift from the 3,000 annual exempt allowance that currently applies. But then any gift over and above that annual exempt allowance would have a lifetime tax charge of 10% applicable straight away, was their proposal. On death, they still felt that there should be some form of allowance available on death transfers, and they even proposed a similar level to the 325,000 currently available to individuals. Over and above that, their view was rather than a rate of 40%, then the tax rate should really be around about 10% for assets up to 2 million. But then over 2 million, the rate should be at 20%. And their view was that at that level of 10 to 20%, it is a low enough tax rate to remove the incentive for significantly aggressive sort of planning against the tax. Similarity to the OTS proposal, they felt that capital gains uplift, so the rebasing we mentioned earlier of asset values on death should be removed. That shouldn't apply either to assets that will qualify for an IG exemption or to all assets. In their case, they felt it should just be completely eradicated. And a shift from the interim report that they had initially issued last year, they were actually proposing in the January 2020 report that business relief and agricultural property relief should also be removed. I should say, obviously, clearly these proposals were, before COVID-19 came, and obviously we've all seen the experience of business owners and businesses around the country since then. So times have moved on, but at that point in time when they were issuing the report, the view was that business relief should be removed, and they proposed, given the tax rate of 10 to 20%, businesses may potentially pay the inheritance tax due by something called an installment option, so pay over a 10-year period, rather than having to find that 10% or 20%, depending on the value of the business, in one go. I think that the third point will be quite radical, given particularly what's happened over the last few months. If the government was to remove business relief and agricultural property relief, it would be a double whammy on businesses who have had to go through COVID-19, who still have the uncertainty of Brexit, to then also have that particular relief removed. So I think that will be, quite a shift. And what I just put in there was a comment from the original interim report by the APPG. So this is not the January 2020 report, but the one they issued last year when the consultation was still going on. And that mentioned that to the extent that businesses qualify for business relief on death, then the CGT tax-free uplift should not be available. There'll be a no gain, no loss transfer on death, and the gain will then be taxed at a later sale of the business by the heirs or executors. This would better align the position between lifetime and death transfers of wealth, and also ensure that if there was a sale by the family soon after death, CGT would still be paid. At present, it is possible for the business to be exempt from IHG on death and sold immediately thereafter with no CGT payable by the heirs, walk away with tax-free cash. This does not seem to justify the policy aim of encouraging the retention of family businesses. And I think that goes back to the origins of business relief was introduced and agricultural relief was introduced to allow family businesses to be transitioned to the next generation without having to close down the business due to lack of liquidity. So, I mean, looking at that commentary there, I think there are similarities to the OTS consultation, which is a case of the current climate where you can get the capital gains tax uplift as well as then get inheritance tax exemption. There seems to be a consistency from the two separate consultations that is unfair, and that particular status quo is potentially untenable going forward. So on the next slide, I've just put in here just a very simple case study trying to compare the current regime as it stands. So inheritance tax legislation currently stands relative to if the government was to, in particular, take up all the proposals from the APPG report, what a new regime could look like. So we have a relatively large estate here, comprising mostly farms and business property. So David, a widower, dies leaving his daughter a working farm valued at 2 million, currently qualifying for business relief and agricultural property relief. AIM portfolio valued at 3 million, which has been owned for the minimum required 2-year qualifying period for business relief, is also in the estate. There's a family business, which is a trading business valued at 1 million, left equally to both children, and cash and house together worth around 650,000. His deceased wife left him everything, which also means that his executor is able to use her new rate band. So that means he's got 650,000 before there's any inheritance tax liability. Under the current regime, David would not be paying any tax on death because the business relief and inheritance tax exemptions will apply for everything over and above the 650,000 threshold. The children would also be able to inherit the assets and get the CGT rebasing, which would mean that if they were to then dispose of the assets shortly afterwards, there'll be no capital gains or little to no capital gains tax to pay. Based on what's been proposed in the APPG report, the same estate, the same structure, you would have effectively a deduction of the death allowance of 650,000 once again. So that's the 325 for David and 325 for his widow. Then 10% would apply on the first 2 million of his estate. And then 20% would apply on the remainder, which would basically mean that the total inheritance tax liability would be £1 million. This is obviously going on the basis that business relief and agricultural property relief would no longer apply, which is what the APPG were proposing in their report. In addition to that, the children would inherit the assets on a no gain, no loss basis, which means any future disposal will see then result potentially in a more substantial capital gains tax liability relative to what would apply in the current regime. So some quite significant changes there potentially. So I think Simon will come on to rounding up on potential considerations from a planning perspective for the estate planning side of things, given what we've touched on there on possible changes there. But just before that, I was just going to then also cover pensions. I think it's probably important to just mention pensions have been a political football as far as I can remember. There's always been constantly changes to pension allowances and the pension regime dating back to A-Day, so 6th of April 2006, when the government brought in the current regime as it stands. Having said that, a substantial amount of private wealth in the UK is held in pensions. According to the Office for National Statistics, 42% of UK private wealth is held in pensions, second to only property wealth. Highlighting the level of changes we've seen over the years, there are two key allowances that some of you may be aware of when it comes to pensions. There is a lifetime allowance, which is the maximum amount you can have in pensions before if you do have pension assets over and above that allowance, you start to incur what we call lifetime allowance tax charges. That's currently 1,073,100. In April 06, it was at 1.5 million, went as high as 1.8 million in 2011-12, then went down as low as 1 million before recently being indexed in line with CPI, Consumer Prices Index, which is now why we see it go up every April, and it's currently at that 1,073,000 I mentioned. The annual allowance is the second one. So you're able to put up to 40,000 into your pension every year and get tax relief on your contributions. But that has also seen a raft of change over the years. Was as high as 215,000 April 06, went up to 255, then went down to 50,000 for a number of years before dropping down to 40. And then in April 2016, even that saw further changes because the government then brought in the tapered annual allowance, which meant individuals earning above 150,000 started to see a reduction in the maximum tax efficient amount they can put into pensions. Particular legislation was then updated in the March budget recently, where there was an uplift of that 150,000 threshold to 240,000, which basically means for individuals ending above 240,000, you now have a tapering of your pension contribution at a rate of £1 for every £2 you earn above 240. For individuals earning above 300,000, then the maximum you can put into pensions now without incurring an annual allowance charge is £4,000. Pensions still represent one of the most tax efficient ways of saving in the UK. For every £100 you put into a pension, you would get basic rate tax relief. And that would equate then your contribution to £125. Higher rate and additional rate taxpayers are also then able to claim additional relief via their self-assessment. So it is one of the most tax efficient ways to still save in the UK. But those reliefs do cost the government, and the table on this slide outlines that cost over a 6-year period. So the most recent data we have is as of 2017-18, tax relief cost the government just over 37 billion. And the view is that majority of that relief, it goes to higher and additional rate taxpayers who are the ones that potentially have the means to make more substantial pension contributions. So what might we see potentially on the pension side? I think bearing in mind I mentioned it's always had regular changes to legislation. I've outlined a couple of points in the next slide. Just waiting for that. So I've just put in there a quotation which also was picked up in the APPG report. So the APPG report I covered for the estate planning side of things clearly was focused on inheritance tax. Was part of the raft of changes that was being proposed in terms of replacing the current inheritance tax regime. There was also this coming in there, which mentioned that all pension funds left at death will be taxed at a flat rate of 10% or added to the estate and excess tax at 20% if the value was above 2 million. So that's consistent with the changes being proposed for inheritance tax. As some of you who do have pension funds now will be aware, clearly over the last 4 or 5 years, we've had the pension freedom legislation, which means that your pension funds don't form part of your estate for inheritance tax. And in the event of death before age 75, there are absolutely no tax to pay on the pension. In the event of death after the age of 75, then the beneficiaries still inherit it free of all taxes, but they pay income tax as and when they take the money out of the pension pot at their marginal rate. So, you know, given the size of private wealth held in pension funds in the UK, given the level of tax relief that the government incurs in cost, applying a flat rate of 10% potentially or 20% above 2 million is not, you know, beyond the realms of possibility in terms of what the government could do. The other thing that could be done potentially very, very easily is, given they've previously always made changes to the annual allowance limits, is to potentially reduce the 40,000 annual allowance available to anyone earning up to the 240,000 limit at the moment to something like 20,000. And that would obviously represent potentially a significant saving on that tax relief table I showed in the earlier slide. Or potentially just removal of higher rate tax relief. So for individuals who are higher rate additional rate taxpayers, you still get your basic rate tax relief when you make a pension contribution, but you can't then get the additional relief via your self-assessment. So potentially those might be some of the things we might see in terms of pension legislation changes. So I think now I'll be handing back over to Simon to just close up in terms of what you can consider and do.
Thanks, Ola. So yeah, so what have we been seeing, and what are the discussions that we're having? I think first and foremost, pensions. Just to follow on from Ola's slides, I guess the make hay while the sun shines is the motto there, basically. I'd be hugely surprised if we get to the end of the year and you can still take additional rate or claim additional rate tax relief from pension contributions. So to the extent that you're capable of doing so, it makes sense to consider that and maximise that before the end of the year. We get the corporate house in order. I mean, just to take a step back, we're very much aware that I'm sure business owners and entrepreneurs have got a whole host of other things to deal with at the current moment in time over and above this. So we are very aware of that. Just keeping the business commercially viable is probably first and foremost on most people's minds. But to the extent that individuals can do it, if it would be good to take a step back and just understand what the assets and activities of the business or the trade is, if it is the case, if it's if you've got a investment subsidiaries in a trading group, for instance, or if there's investment elements to your corporate at this moment in time, then it's most certainly sensible to have a look at that sooner rather than later, with specific reference to Ola's point around the 80-20 rule and the potential changes on the horizon there. A lot of business owners, especially with more complex structures, would have been planning around the 50-50 rule for business relief. So if there are changes to that, then some form of corporate restructuring would most likely need to take place, or at least you need to be aware of that and understand that. I don't necessarily think we can have this dialogue without also maybe looking at just getting the corporate house in order, or the house in order in general. So governance and succession planning comes into this as well. It would be sensible to do that at the same point. Whether or not that's formal or more informal, it largely depends on people's circumstances. But we'd certainly encourage individuals to do that. Realizing assets sooner rather than later. So if you did have an intention to realize assets, sell assets down at some point during the year for whatever given reason, then we'd certainly encourage you to do that sooner rather than later, certainly before the autumn statement in November. It makes sense to do that, to lock in rates as they are now. It's obviously a separate discussion whether if you're looking to do something strategically, and we'll come on to that. Equalizing marginal tax rates between spouses. Now, this is something that we would say is fairly standard advice going back a long period of time, disregarding the position we're in now. But if you can transition assets between spouses to make use of lower income tax positions, then that would be a sensible thing to do. Similarly, if you do have investment portfolios that are pregnant with gains, and it may be sensible to look at transitioning those investment portfolios to make use of a lower income tax paying spouse, given the conversations that I had earlier on about the potential changes to capital gains tax and the ability to transfer at no gain, no loss between spouses. Clients that have got the mindset where they're potentially looking to make gifts to the next generation and devolve wealth, that makes perfect sense. If you're in that position and you're thinking about doing that, then we'd certainly encourage you to simply because of all of some very valuable allowances and reliefs available. The gift out of income, the normal expenditure exemption that Ola talked about, I think is still can be used very very wisely by a lot of individuals. There's a separate question as to whether or not that would be outright or into trust, and more than happy to continue that dialogue with any people that are interested in that. Now, we haven't focused too much on UK connected international clients. Relative to the last few years, I think a lot of the talk has been less so about changes to the remittance basis and so forth. I think we have a question about that coming up, but clearly the UK isn't alone in having to deal with a lot of these issues. So if we do have internationally mobile clients that have touch points in different jurisdictions, I think it's important to understand what's going on in those other jurisdictions at the same point. And plan accordingly. But I think really it's a case of seeking professional advice in relation to that, and happy to have those conversations. And then I think just to be clear on this, there's a danger here that we're slightly too hasty in jumping into doing some irrevocable planning without really knowing exactly what's around the corner and basing planning. We're not encouraging you to do that in any way, shape or form. I think that probably leads me into the conclusion for this presentation, which is we don't think you should be doing anything knee-jerk, but to the extent that it's possible, I think it is a very good time to try and do some strategic thinking around what you want to happen over the next 5-10 years. There's so many moving parts at the moment, then I think it makes perfect sense to try and take a step back and look at your situation in the round and try and plan accordingly. And that's something obviously that we try and do for clients. I just wanted to run through the methodology that we would typically employ in dealing with clients, because disregarding the technicalities, that it's a fairly simple methodology that you can employ across the board, really. First and foremost, again, I'd encourage you, it sounds like a very simple point, but understand your balance sheet. That can be at a very complicated end of the spectrum if we're talking about various different corporate structures and other different entities or assets in multiple jurisdictions, through to the other end of the spectrum where you might have a couple of pensions you haven't reviewed for the past 10 years. I think just taking a step back and understanding what your overall balance sheet is and what you have in place is a sensible first starting point. And that in itself, I've found, certainly having gone through the experience myself, is quite a therapeutic exercise. If you've got various different things you haven't known anything about for a fairly substantial period of time, getting to grips with that can often be very therapeutic. And then really understanding what you're trying to achieve. So clearly, and I think with this, we talk about tax. Tax is important, obviously, but there's a whole host of non-tax issues that would drive a lot of the dialogue that we have with clients. And I think most people look at it from that perspective. So whether or not that be looking to devolve wealth to the next generation or protect the next generation from wealth, or whether or not that just be making sure that that you've got sufficient resources to be sustainable over a period of time. There's a whole host of potential things that you could consider there that I think it's important to have everyone to be on the same wavelength at the outset. And then the wealth planning team has some very sophisticated tools at our disposal to stress test different scenarios, to look at portfolios and look at portfolio returns, inflation, and to project forward the balance sheet and do some quite sophisticated analysis and to look at individuals' positions and look at the monetary impact over a period of time. Again, more than happy to expand upon that with anybody that feels is relevant. Ultimately, you want to get to the position knowing, projecting forward and knowing the potential implications of your balance sheet given certain situations. And then if you analyze the individual tax position of each component part of your balance sheet, then I think you've got sufficient tools to ultimately put together an overall strategy that accounts for a whole host of all of the different moving parts that we've talked about within the presentation. I think that comes to the end of the actual presentation itself. We did have a few questions that came through. Thank you very much for those that sent the questions in. The first question was, and I'll probably give this to you, Ola, if that's all right, was around the pensions tax-free cash, the 25% tax-free cash. Can you see any changes on the horizon with that?
Yeah, I mean, it's one area where we've always had potential concerns, where there's a budget coming or an autumn statement where people feel that potentially that might be going. And I think there has been changes historically to the tax-free cash. You know, there are individuals who potentially had 100% tax-free cash dating back to pre-April 2006, when the government brought in the new the current pension regime of sort of 25% tax-free cash being the standard amount. And those individuals were still able to keep their tax-free cash in there for 25%, albeit subject to certain rules, and we still come across them when we advise clients. Some of those rules would be, for example, if you were to transfer away from the current pension structure, then you would lose that protected tax-free cash amount. So I don't see a situation where there will just be legislation coming in straight away. That means on day one, 25% tax-free cash now drops to 20% or 15% or zero. I think if anything was to come around that, it would probably be similar to what we saw in April 2006, which would be individuals who had 25% tax-free cash would have some form of protection for that tax-free cash, albeit subject to certain rules. And it's only then further benefits down the line that will be subject to tax. The other side of it is the 25% tax-free cash is, once again, probably quite an emotive subject and will probably be deeply unpopular. And I think with all of this, there's always going to be an element of the government looking and going, actually, which is the low-hanging fruit that we can sort of, take apply some tax increases to without causing too much political damage to ourselves. So all in all, I don't think there'll be changes to 25% tax-free cash, but if there is, it's highly, highly unlikely to be retrospective.
Thanks, Ola. I think just to add on that, to expand on that, I would agree with you. It probably is the biggest political football, I would say. So if, my viewpoint has always been, if there were to be changes to that legislation, I think I mentioned earlier on about tax deferral or deferred taxes. I think that would be one of the ones where they may say in 2-3 years, for instance, that the tax-free cash would be removed. I'd be very surprised, because of how emotive it is, that this suddenly would just remove the ability for individuals that have saved up all of their lives to have, with the knowledge that they have that in the background, to suddenly take it away from them, because it'd be very politically provocative, I would say. Thanks for that, Ola. One other question. So should we be considering bringing forward income payments in light of potential future tax rises? Yeah, very good question. So I think this will be referring to people who are in a position where they can potentially have SIPs, for instance, or pensions where they can potentially take further payments in 1 year versus the next, or indeed if they've got corporate structures, for instance, where you can have a degree of control over dividends and when they're paid. I think the answer is potentially. I think I can certainly see situations where it might make sense to do that if you know that you've got a specific requirement to extract income at some point in the near future, and that's fairly rigid, and it doesn't, by extracting the value, put you into, by default, an additional rate of tax as things stand. Then I can see potential logic behind it. But I think this is a prime example of the last slide that I had within the presentation, and the points around not to do anything too hasty or too ad hoc. I mean, I think it's something that should definitely be explored in specific situations. But I think for those that think that is a potentially viable option, I think really you need to take a step back, understand exactly what the bigger picture is, what's trying to be achieved, and then work through it methodically along those lines. For instance, extracting value from pensions has further inheritance tax implications and so forth. Corporates look relatively attractive relative to personal rates, assuming that individuals may have a reasonable amount of other capital and other resources to call upon before making that judgment call. So it makes sense to explore, but it needs to be explored in quite a lot of depth before anyone makes a move along those lines. There was one other question that maybe, Ola, you could take around international clients, the remittance basis, and do you foresee any changes in that respect?
Yeah, we haven't actually covered that in too much detail here, but in the notes we will send afterwards, we put a section in there on international clients. But going back to the APPG report I referred to a few times earlier, that did actually address the subject of international clients. The proposal there was to possibly remove domicile being the connecting factor for inheritance tax in the UK, as people who advise and work with international clients, and international clients, the audience will be aware. If you're a UK resident, once you become UK resident out of 15 out of the last 20 tax years, then you become deemed UK domicile for inheritance tax purposes, which is the only point in time you then become liable to inheritance or worldwide assets rather than just UK citus assets. What is being proposed in the APPG report is to remove domicile as a connecting factor and change it to residency. And also then it would then be a case of, once you've been UK resident for 10 out of 15 years, would then be where you then be liable to inheritance tax on your worldwide assets, but similarly at that rate of 10% up to 2 million and 20% thereafter. I think the key thing there is we obviously saw quite significant changes to the domicile legislation in April 2017, and there's been further sort of tinkering since then. So I think it's one of those where it's a very, very complex area. If we are going to see changes on that side of things, it's not likely to be in the near future. There are other sort of legislation specific to UK resident, UK domiciled individuals that the government will probably look to deal with first. So I don't think that's something that we see coming in the near future, but it's in the proposals and can't be overruled for the longer term.
Okay, thanks, Ola. We have had a couple more questions coming through. One question, if there was a wealth tax transfer, could it have any retrospective effect, i.e. would the 30k stop from when it is introduced? I think it probably goes back to my point around gift tax, making gifts and bringing forward gifts and thinking methodically about that. Again, so Ola, you may have separate opinions, but we'd be amazed if this was retrospective. If people are minded to make gifts, then it makes perfect sense to try and make those gifts to the extent where they're sure that the gifts are going to be outright gifts and they're comfortable relinquishing ownership of assets. Then it does make sense to make those gifts sooner rather than later, because we couldn't see a situation where the government would go back and retrospectively try and account for those gifts. So that's certainly my view. I don't know whether Ola, you have a separate view on that.
I mean, I agree with that. I think the 30,000 annual exempt allowance being proposed, and then the 10% transfer tax after that, is a complete sea change to what we have at the moment, where you can gift as much as you want, live for 7 years, and it falls outside of your estate. So if the government does go down the route of replace the current legislation rather than reform, then it'll be very, very difficult for them to then retrospectively then say, well, the gift you made 6 months ago, 3 months ago, now we brought a new legislation, we will then retrospectively tax that. So I don't foresee a situation where that will come in.
Thank you very much for the question. One other question, do you foresee any change in ISA allowances, please? Personally, no. I think, the ISAs have been hugely popular, hugely successful, and I don't necessarily think make too much difference in terms of the overall tax take in the grand scheme of things. So I could imagine them just ticking along as normal, or the government potentially introducing a little sweetener to ISAs and making them slight, which they have done historically by raising the rates as a small sweetener, whilst the increased tax takes across the board in other areas. So I certainly haven't heard of anything specific that would target ISAs, or any specific ideas around removing the tax benefits of ISAs going forward. I can imagine they will stay as pretty much as they are, and obviously I think that if that is the case, they'll become fundamentally more important, most likely, as time goes on. The clients use their ongoing ISA wrappers, because invariably anything that gives you a tax-free allowance when taxes are most likely rising is a very valuable thing to have. So I think that's pretty much us done now. If anyone has any questions, more than happy to answer those questions. Otherwise, thank you so much for joining us today. Please feel free to get in touch with us, or get in touch with your wealth managers, and more than happy to pick up anything with anyone in due course. Thank you.